trades that we're watching. One will be Chipotle and one will be Amazon. Amazon was an earnings trade and Chipotle was a trade kind of based on some technicals that we were looking at yesterday. So let's look at Chipotle first. It looks up here. If you look at our portfolio, this is our position portfolio for the options versus stocks that's being tracked by TraderMob. TraderMob's tracking all the trades we're talking about. We're talking about multiple strategies and how they compare against each other in different scenarios, and we discuss them and analyze them, and we have TraderMob track them for us and show all the details of what happens throughout the lifetime of the trade for educational purposes. Now, CMG is up. This is sorted by profit, so CMG is at the top of the list here today. So it looks like Andrew made some good trades on Chipotle, and let's talk to Andrew about what happened here and see what he has to say about the trade. Andrew?
Sure. Let me share my screen. Let me know when you're seeing something.
Go for it.
Okay, so what I want to show first is something from TradingView, and I don't know if anybody's familiar with them or not, but what they allow you to do is save an idea or save an image. And I'm going to show you that one from Chipotle. This is from 2 days ago. And what this saving idea or save an image does is that at any moment in time, you can save your chart. And it freezes that for you, and whatever the technicals you had set up or whatever ideas and thoughts you had were frozen in time. And the point of that being is that then you can go later on, come back and hit one of these load new bar buttons or play buttons.
Oh, I've seen that.
And then it loads the new bars for you and shows you what happens. Now it doesn't follow through with any of the other technicals. The W% won't build, and if I have added things to my own chart to this since, but those won't show up here because it only took what I had done at that moment in time and saves it, and I can't do anything to it. I can't adjust it. Once it's saved like this, this is it. And that's part of the whole thing, one of the things at TradingView that you can do and what they do over there. So let me show you what happened. This is what we drew on 2 days ago, and I saved the image to see if anything would work out as I hoped. And sure enough, if we load the new bars, we can see this is an hourly time scale. And this is a target I'd drawn based on technicals, and then we can see the Chipotle lifted up and hit it really nicely. And if we go over to the 13-minute, I was looking again at some targets is what I'm talking about more specifically. Some confluence going on down here, a couple places where I thought we could come down and see a test, and then again the higher target. And if we load the bars and see what actually happened, we can see my first target was hit pretty much dead on, and the market jumps up and hits. So I wanted to show that, and the reason being is that I've just shown you, if anybody goes back to yesterday's video or the day before when we did this and first showed this chart, these were there, and you can see that I have drawn ahead of time by 2 days exact places and price and time where I thought the market would be.
Andrew, so those circles that looks like a bullseye, those were targets you placed on the chart prior to today. And
exactly.
They existed there 2 days ago, whatever, when we first looked at this as your price target. And now you're showing, what actually happened, and it showed that target was hit and just bounced right off it.
Yeah, I had the 3 targets here, and they don't. The point of the targets and what I'm saying is that there's a good idea that there's a good possibility the market will move to these, and these are what I call high probability target zones, and they have to do with the confluence of technicals. And where there's a bunch of technicals coming together, I say that's where the market will move to, and that's where I have found.
Is that target drawn in a form of a bullseye on purpose? Because
yes,
like that, you're kind of like looking at the probability of going.
Well, I used to draw squares, and then I was drawing some other things, and so I've come down and I've gone through a couple different things, but I settled on the target. The issue is with finding these targets and why I use circles primarily, or a square, not just a little dot, let's say.
Right.
Is because if you can imagine this line, it goes back really far, or even one of these trend lines, or any of these trend lines that go back far. And if you know that if you have a trend line and it's tilted on one end just slightly, the opposite end is going to be way, way off, right? Just by if one end, so these go way back far, and so I draw circles because I know it's not going to be an exact point.
Right.
It's going to be in some general area. And let's be honest here. This was like a day and a half, 2 days ago, and this is a 13-minute chart.
Okay.
I'm drawing on it. I drew that on a 13-minute basis, not on an hourly basis, but on a 13-minute. So, a day and a half later, it still comes down and hits my target.
Okay, so
this is on an hourly chart that it moves up.
So just to be clear, Andrew, this is a chart from 2 days ago?
Yeah, this is what I saved.
Say it right.
2 days ago on TradingView.
Right.
What the market looked like, why I was going to trade it. What I wanted was to see some kind of resistance lift off through here. It's telling me that this channel was in play, that this had been broken, that we were in, and we are now moving towards the green. Coming off here, retesting it, lifting up through, and that's yesterday, I believe it was, when I took the trade, and we were looking at the market, and I said, okay, I'll go ahead and take this trade.
Now you're loading. You just loaded the next day.
Yeah, I just loaded the next 2 days. That's everything that's been printed ever since I first saved this chart. So
okay, and then
on Monday it'll show Monday stuff too.
Okay, I just wanted to make it clear that you hit that button and it loaded the next 2 days, including today.
Yeah. Yep.
And that price target that you just drew, that we talked about, it just got hit right there. That little peak there.
Both of them. This one and the top one, both of them.
Okay.
Came down and retested exactly, and then lifts up to my target. And so this is where we were yesterday, as I saw this going on, and I believe we were breaking out over this stuff, and I thought, okay, we're going to see a push, and I want to see some support. But this is what I think we had on the WSR. It doesn't show on this one. I'll actually go to the real chart now, so we can show this is the actual chart from CMG now. It was in here yesterday that I was thinking about what's going on and wondering, take the trade because we had a lot of strength. We had lift and support going on over here. Same with this. And the real thing, my real target, sorry for that. My real target was here on the daily. Remember, I said I was looking for a lift back up to this top channel into the blue zone, and potentially the 34 MA was where it goes. And that could still be a potential target for Monday, Tuesday. We could still see that pop. But that was the reason I took the trade, is we were down here, and I'm looking for that jump up to the 34, which is pretty much what we got. And then for my exits this morning, I watched the lift. If you recall, I took some short-term daily, like 1 week option expiration and a 1 day one day option expiration. Yeah. I actually did that mistake
yesterday to summarize. To summarize, yesterday you based on our analysis yesterday on CMG, you took a long call play and a short put play, right?
Yeah, I wanted to see what would be the better play. Just if the market goes, even if it didn't go on my way, which one would lose more money, or which one would make more money?
Exactly.
I bought a long call or a short put.
Okay, so walk us through what happened today.
Yeah, so when I watched the market come up, and when it hit here, I sold my dailies, or their weeklies, but they had 1 day to expiration, and I actually meant it to be a weekly because I knew this would pop. I didn't know for sure today. I thought maybe Monday or Tuesday. Right. If it
you got lucky.
Today.
You got lucky. You got your.
And I meant to buy a weekly because I thought Monday, Tuesday. By Tuesday, if it doesn't pop, then it's not gonna. But by then it should, and it happened today, and so that was why I didn't actually change the mistake. I thought, well, I'll just leave it on and see if it actually happens Friday as opposed to Monday or Tuesday.
And it did.
I didn't know it would be so severe, and I thought it might take a little bit more of a longer time to get up over a day or two.
Right.
But whatever, I'll take it, right? So because we got the movement today, and it tested, you can see this top channel that was the market we've been following in, as well as the other one. It came pretty much closer. So that was when I got out of my dailies, the really short ones. And the reason I got out of them at that point in time is because there was a chance and an opportunity for the market to come back and test this channel or the 34 MA before it continued to go up. And at this point, I had no idea what it was going to do. And my thought at the time was, well, this is expiration today, and if this comes down any bit and doesn't make it back up, I'm screwed and I'm not going to get any profit, and the options will probably be crushed and be worthless. So I got out of them right here. That was the two really short time long call. That was the long call and the short put with only a day left. And then my next ones, I got out of everything as we broke up into here, and I hit into my target area. I didn't wait for the 470. I didn't get out of the top. That was a target consideration. But at 465, we were hitting another significant resistance, and we had just moved 10 points. So I thought, well, you get another 5, maybe I won't, but I'm taking my profit here. So I dumped everything there, expecting it potentially to reach up here, but if not, at some point to come back off it, which we can see it did in a couple hours. Not even. Like I said, I got out here, so half hour, 45 minutes later, it dropped off.
So as soon as it started as soon as the CMG started entering this, and you can't see me doing this, Andrew, but I'm circling the outer edge of your price targets. As soon as it started entering that zone, you started taking profits.
Well, yeah, the zones give me something to look towards. And something to consider as to a price objective, because I know there's some confluence and I have an idea the market's going to move there. I don't know with any certainty which one of these is going to be in this area.
Of course, but once it enters that area, that outer circle, you're starting to look at, that's the area.
I'm looking. Yeah, how I trade is that I move from one significant technical to the next. So this was the significant technicals in here,
Okay.
and like I said, as soon as I broke over this, I was over $10 lift today. I thought maybe I'd get up to another 5, but
You weren't.
how much do I
No.
want to push this? I don't
You
want to
already
push this.
got your move at that point, and why try to go for the
Exactly.
extra? Why try to go for the extra
Exactly.
couple points?
Exactly. So that was my reasons why I took the trade and why I got out of to see what happened. I mean, I could have just as well been wrong and kept going, right? But this is what happened.
That's not what you do. That's not how you trade. You don't. You
Exactly.
just let it go. If you miss another 10%, fine.
Yeah, be happy with what you got. And so let's take a quick look at what the options actually did, price wise.
So let's go to your trade page. Yeah.
Yep, that's where I am. And so
can
you can see.
Can you zoom in a little bit? Can you drag? Oh, yeah. Let's do that a little bit.
So you can see. This doesn't show you the form very well, but it gives me a nice shot that I did a nice job of getting in. Did get at the top, got in.
Cool. So I can see. Okay, so I can see you sold a May. It shows that you sold a March 440 put yesterday. Is that right? No, this morning.
Yeah, that was. I made a goof. Remember, we did that one goof.
Right.
I it on the 28th. So I'll show you. Let me show you my trade action list, and that's this one in here. I think the 28th. I bought and sold on the same day yesterday. I just bought the one, and I meant to buy it short, and I went long.
But that spike there, I'm looking at the spike there right now, and then on the top, near the top, it says you made an options trade. So that's where you closed out your long puts or your short puts.
I closed out everything. You can see.
Go down to the activity, yeah.
Yeah, if you can see.
Let's see what you did. Let's scroll down to down more. Scroll down more, and then let's start from the top of this activity. So yesterday, okay, you made the trades. You bought a call. You bought a call. And let's look what happened today. Let's go to today's activity.
See Thursday,
Friday. Okay, so today looks like you just
showing 3.
Okay.
3.
Right.
I don't know if
so
showing 3.
At 9:54, well, Pacific for me, you closed your call, you closed your 2 calls, and you bought to close your short put. Is that correct?
Yeah, that's what it looks. That's what it sounds like. I don't know if it's giving me all my transactions. You can see exactly through here.
Yeah, it shows them all there too.
On this one, what I bought it for, I ended up buying it for $6.90.
Yeah, right.
And then getting out at $12.90, so almost a double.
So you doubled your profit on your long call, right?
Yeah, and that was the same. That was the 1 day to expiration. That was the really short one.
So to be clear, to explain, you took a shot with a very short-term long call,
yes.
Right? And
Pop hadn't happened. I would have been in like Netflix. Starbucks the other day. It would have been nothing. It would have been a minus. If I had moved in my direction.
It was a gamble, but you saw the opportunity. You maybe probably wouldn't have risked that much. Went into it.
No, like I said, I meant to go a week out. Is what I meant to do to give myself that more time, not just 1 day. So that's really what that should have been, a week out, not the 1 day call.
Sure. Okay.
And then the next one, I bought a February call, and that one was at 25, and it sold at 30. So it didn't quite get as much gain, but it still got a nice, I think, 20% or so. So it went from 25 to 3,000, and then
where's the sold
500.
put? Let's look for the sold put you sold. Oh, yeah, there's the one below that.
Yeah, so there's the puts sold. Oh no, that's
so right here below that. Puts. I'm looking at. I put my cursor on it. It's it's open sold 1 CMG put at 440, and then you bought it at 1.
Yeah, so that was a nice crush.
Right. So that basically you can see how much value that put lost because of his move. And the cool thing about puts is, let's see, you sold the 455. What was CMG trading at when you bought it? Was it an out of the money put? Do you remember? 440. Well, if I look at the chart here.
No, it was right at. It would have been at the money. Yeah, I was trying to get these close to the money at the time.
Right. Yeah. So if Andrew wanted to, so Andrew could have done a couple things there. He sold the put at the money yesterday, because he wanted to get an upside move. But if Andrew wanted to give himself a little more room for it to be wrong, he could have sold an out of the money put, right? You could have sold
just out the money.
Yeah, instead of at the money, you could have went out like $5-10 and sold that one. You will have gotten less credit, but you would have given yourself a little room to be wrong, and you would have made money either way. But if you were wrong and it didn't go down, it didn't go up, you still would have made money if it stays flat. That's the thing about the selling of the put. You would have made money in a flat move or an up move, And in this
Exactly.
case, you got both. You got everything you went right for
Yeah, I
this
would
one.
normally put this trade on. Like, this is obviously a really bullish trade. I mean, I bought long calls and short puts. So I mean,
Well,
I wouldn't do the same. I don't know if I do the same thing on one trade, but I would go long call or maybe a short a put,
of course,
hoping for that
yeah,
move.
you definitely wouldn't do that in a real trade, but this is for this demonstration purposes. So, I think the question for you next time is, if you were trading, if you're trying to make a single trade on this, would you have chosen the short put or the long call? And that's really the question.
Yeah, I
And
don't know.
both, yeah, exactly, both would have made money, but both have different advantages. You
If
would have
risk
been,
profiles about the two, I like the idea about selling the put and getting some time. It's because if I'm
yeah,
not correct, it goes in
right.
my direction, or
So,
even if it just doesn't go against me and just stays flat, I can still have the opportunity
So
to make the money.
in this case, if you would have sold the put and you didn't get your move in one day, then that would have been the better choice. Because you normally, I'm going to bet that you're not going to get your move in one day, like exactly the next day.
So I
And
am trying. Although in when we did Starbucks, I got the move the next day. It just wasn't in my direction,
okay, yeah. So it was
right?
yeah.
And
So
so I am trying for that. I am trying for a 1 day, 2 day pop. That's part of the technicals and trying to
the
time it
technicals.
to get it right to get in to say, okay, we're going to pop soon or we're going to move soon, because part of the technicals and specifically with the options is that options have a great deal of timing. This is
Yeah.
what I'm trying to
So
figure out with the technicals.
it's funny you say that because we're coming from two sides of things. You're coming from the technicals. I'm coming from the options,
Yeah,
neutrality mentality. So it's like for me, I'm thinking to myself, how do I? I'm constantly thinking to myself, how can I make a trade where if I'm wrong and my timing is off, I still don't lose money. And you're thinking of, oh, if I'm right and the technicals are right, how can I make the biggest bang for my buck, right?
exactly. Yep. And at the same time, I'm also thinking, I'm also weighing that with risk. I'm also saying, yes, my biggest bang for my buck, but then where is my exits and where do I need to get out if I'm wrong?
Yeah.
Because I got to be quick, otherwise, especially with options, you can lose all your money really fast.
So it's cool. I like this this view that we're looking at here because it shows how you sold the put and then you closed out near the top
It's pretty close.
on the way.
It
It's
wasn't
pretty.
the
I
top,
mean,
but like I said, like we showed on the chart, it was pretty close to
yeah.
where I
And
showed everybody. The first one was in here, and then the next ones were just in here, and then it still gave us another 5 points. But I was
Can
happy.
you attach that final can you mark that up and attach that final image right there that we're looking at there and show that maybe
Sure,
a little annotation text that says this price target was hit and then just attach it to this trade and it's going to go in the
I'll do
archive.
this one too.
Yeah, and this trade is going to go in the
See what
archives for future reference.
I think with the best, although the trade and everything went well, I think the most amazing thing that you viewers should take a look is the fact that the market moved to two exact places in price and time that I chose days earlier.
Right.
That's not random.
It basically
That's
bounced off.
technical.
So if I'm looking
And
at
I
this
had
right, what's that?
I have no forethought of the fundamentals. I didn't know what was going on. I don't. Was there news today? Why did we get that great big spike? I
I
have
have no
no
idea.
idea.
I don't follow the fundamentals either. Actually, when I trade, I trade based on just all these other things during with options. You
But
trade in
anybody who's
technicals.
watching this, sorry, anybody who's watching this the last couple of days, we can go back and take a look. And I clearly say I'm waiting for a pop here to come up to the back to here in the 34, and that's all technical. I don't know why I
Yeah.
did it with if there's news today, but for me that was why the move happened.
So when you upload your chart, attach it. Make it clear that your support was bounced up right off of, and then your price target was hit, and then it just bounced off that as well.
Yeah, as soon as it went right up there and fell off.
And then maybe you can
Nothing.
you can add a note of what what you're looking for next.
Yep,
And then we'll put that up on the trade page, and then it'll be there forever, and then people will be able to see it later on when they come and check out what we're doing.
sure.
Very cool, very cool. Okay,
All
we're
right,
gonna switch
that's all I
over.
had.
Are you good?
I'm good. Let me stop sharing.
All right. I want to show something else very interesting. That is kind of it kind of tells a lot about how options work. Um, Yesterday we placed a couple trades on Amazon. So Amazon had earnings yesterday, and as you know, as you should know, if you're an options trader, earnings prior to earnings, volatility increases dramatically for any kind of option. So if you look at Amazon right now, so Amazon yesterday, if you look at these yellow lines, these represent implied volatility, and as the market was dropping in January, plus earnings, volatility was pretty much at the highs of the near the highs of what it has been at historically. So it was near the highs yesterday at earnings, and I knew that when earnings is out, this line represents the drop in volatility that happened. So volatility got crushed, right? It came from here all the way down to here. That means your options that you sell or you buy, that means the options across the board, especially in the front month, are going to get crushed. And we placed a couple trades on Amazon to see what would happen. And what happened was really quite amazing. And it's something that you won't understand unless you see it happen. So let's look at our first trade. It's the neutral trade. So we sold a short strangle on Amazon, and we sold the 700 call and the 590 put. Okay, it dropped all the way to 584. So let's talk about this for a moment and think about this and understand what happened. Amazon is trading at 584 right now. It dropped 8%. That's a big move for a stock as big as Amazon. And we sold the 700 call and the 590 put. So it actually breached the 590 strike. It went through it slightly, which is not good for options. When you sell options, you don't want them to go through a strike. This trade's up 500 bucks. So it profited 500 bucks. And why is that? Because first of all, the long calls got crushed. So the long call, 700 call got crushed. I sold it for $11.55. They're worth 42 cents now. So that got crushed because the direction was wrong. The stock dropped, so the call decreased in value tremendously, and the volatility came out, and now we're looking at a 42-cent option that I paid 11 bucks for yesterday. Okay, yesterday. Now the put was 18 bucks, and it only went to 23 bucks. So you would think, so in Andrew's case, he got an option that doubled in price in one day because the stock moved in his direction. But we got a stock that moved in our direction for a put, and it didn't even come close to doubling. You know, it's only worth 23. So in other words, the loss in value of the gain in value of the short naked call overcame was bigger than the loss in value on the naked put that we sold. So we lost money on this and made money on this, but we made more than we lost, and now we have a net profit. And the stock moved 8%, and that's a pretty big move for a neutral trade to still make money. And that's from purely 100% implied volatility coming out of the options. Otherwise, there's no way this would have made money on a regular trade where the stock moves 8% and you were short a strangle. On any given trade, if you're short a strangle and the stock moves 8% against you and hits a strike, you're going to lose money, I can guarantee it, unless volatility sucks out of it like it did here. So this is all volatility. Now let's look at the other trade. Here's what's interesting. Let's say, well, let's look at the sold put. We sold a put. We bought a put here. So on Amazon, we bought a put, which makes money when the stock goes down. You're bearish. Buying a put means you're bearish. Look at this. We bought a February 520 put at 296. It shows right here. Amazon dropped 8%, and we got our gap down. We're down 94 bucks. We lost money on this trade. We got our direction. We got our timing right. We got two out of three things right, which is a pretty good thing to achieve in options trading. We got the timing right. It happened in one day. We got the direction right. It was down. Hey, we lost money. We actually lost money. Look at this. The long put, we bought it for 297. It's actually 273. So after an 8% drop, and it happened right away, so time value didn't even have a chance. This This did not lose any time value much here. I can guarantee you that, because we just opened this yesterday. So we didn't lose any time value. We got our direction right, and this thing still down this 273, and that's all because of implied volatility. So volatility came out so dramatically that it created the puts lost so much value that we couldn't even make money on this trade after getting everything else right. So that, and this is not just, this is a lesson that you should understand in general. So earnings has a dramatic decrease in volatility because it's known to, it's a binary event where everyone's waiting for it, and all the volatility is pumped into the options, and once it happens, all of it comes out at once in one single day. But you can imagine this can still happen in a normal scenario where you buy puts, stock moves in your favor, and you lose money, and you're like, what's going on? And it's because of implied volatility usually, and normally it's because of that. And sometimes people don't understand that, and they don't get it. They don't get why they're losing money when they got everything right. I bought puts on it, and the stock went down. Why am I losing money? And this one should be obvious. We bought the call, so this one's going to get crushed in two ways. It's a double whammy here. It loses money because we bought the call. We want it to go up. If we buy the call, we hope the stock goes up. It didn't, so we lose there. Implied volatility comes out, so when you buy a call and implied volatility comes out, you lose all that value, so you get crushed everywhere. And it shows here it's worth 10 cents. So we paid $5 for it, and this is why options. This is another reason why people lose a lot of money trading options, because they'll tell you, oh, just trade options because you have limited risk and you can only lose what you put in. But just remember something, you can lose 100% of what you put in a day. I mean, you're not going to get this back. I can guarantee you're not going to get this back. You might as well just take your losses now, or just leave it and just hope that you can get back a couple, maybe 5 cents if Amazon would have to rally a tremendous amount for you to get anything back here. So you just looked at a one-day loss of almost everything you put into this trade. So sure, yeah, it's true. In options trading, you only lose what you put in, but you can lose 100% of it pretty fast. And what people don't realize is that you're not going to lose 100% of your stock value in one day after an earnings trade on a company like Amazon. I mean, maybe on another company that's kind of, a small cap company that's kind of unestablished, but you're not going to lose 100% of your 50%, even 20, 30, 50% of your, your stock value in a stock like Amazon or Apple normally in one day. So keep in mind, this is the danger of options, of how dramatically you can lose money based on implied volatility. If you don't understand all the things that affect option prices, if you're trading options, don't do it, because you're going to lose money. If you don't have a good understanding of the fundamentals and how things work, how your option prices will behave based on changes in the environment, you're going to lose money, and you're going to waste, and you're going to have a hard time. You're going to be frustrated, and then you'll end up quitting. You'll probably end up quitting trading options because you think it's impossible to make money, and you'll give up before you even give it a real chance. And we're here to help you to give it a real effort and learn the right way, and learn all the basics and practice all the basics before you actually put real money into work, because you need all the help you can get and all the practice you can get before you actually try this. And it's not easy, so you're going to have to put some time into it. So I think we wanted to get across our CMG trade. That was a great trade on Andrew's side. The technicals worked out perfectly for that, and that's kind of cool to see when the technicals work out perfectly for a trade. And not only that you can take the action based on what you thought was going to happen, and he did. So congrats on that. That's a good trade, a great trade. And
yeah, it doesn't always work out that way, but it's nice when it does.
It's not going to always work out that way, and it's never going to always work out the way. But
it's the markets, right?
But it's good just to have, to stick with your rules and stick with what you believe in, and be disciplined to kind of follow follow what you do best and know best. So Kudos to you on that. And for the Amazon trade, I really hope this is a learning people learn a lot from this Amazon trade, because I know people who have traded earnings, and they'll do things that they'll just think of direction. They'll think that, oh, their earnings are going to be good, so let me get some leverage and buy some calls, and then that way I don't have to risk so much money by buying stock, because if I wanted to make some real money on it, I'd have to buy too much stock, and I don't have that much money to put in. So let me just put in, like, a small amount into an options trade, and then that's going to be my better choice. And then they won't realize that they have such a small chance of making money, that it doesn't make sense to do it if they knew that what they were getting into. All right, cool. So I think that's all I wanted to cover today. We're probably going to let these. Andrew and I are going to kind of annotate these trades and kind of put notes on the trades about what we were thinking at the time and what we were. And he's gonna upload the technicals, and I'll probably close out this trade and show that this was a naked strangle to demonstrate the implied volatility changes, and how they affect the option prices, and to show that, well, you can actually make money on a trade that moves, on a stock that moves this much. But the reason why we were able to make money is because there's so much implied volatility that we were able to sell way out of the money options and still make money and give us that edge, and that's what you're looking for in options. All right, so that's it for today, and have a good weekend, and we'll be back here on Monday.